Hello and welcome back to the fixed income securities of the NASM series. So let's start with the chapter 1.2, that is importance of debt markets. In any economy, the government generally issues the largest amount of debt to fund its expenditure. A well-developed debt market helps the government to raise debt at a reasonable cost. A liquid debt market lowers the borrowing cost for all and it provides greater pricing efficiency. Debt is funded either by bank loans or by bond issuance. A corporate bond market dealing with issuance of pure corporate paper helps an economic entity to raise funds at cheaper cost. The debt market brings together large number of buyers and sellers to price some debt instruments efficiently. A developed, a well-developed debt market reduces degree of banking support for the economy as risk is distributed among many investors. A well-developed debt market helps the banking system with a better asset liability management. The development of a well-functioning debt market helps to channelize the collective investment schemes to invest in this market and also facilitate in bringing retail investors to invest directly in debt. The well-developed and liquid debt market also helps various long-term investors like pension funds, insurance companies, which have different investment objectives as they invest for a very long term to match and minimize their liabilities. The primary debt market helps governments and corporates to directly sell their securities to investors. Typically, governments issue debt market through auctions while corporate issues debt papers through private placement. The secondary debt market provides an exit route to the investors and it also provides important information on price discovery process through credit risk appetite, spread, and default probability, etc. The tradability of bonds issued by a borrower helps the market in getting required information on the firm. However, in practice, issuance of debt is a multi-level process adhering to the various regulations. It involves underwriting, credit rating, listing with the stock exchange, coordinating with issue mergers or issue managers to distribute to the right investors, liquidity in the market, banking support, etc. A well-functioning debt market would require developed and sustainable legal framework with clear bankruptcy codes. The regulatory cost of uh, the debt can be at times prohibitive for smaller borrowers. Hence, small and medium firms usually prefer bank borrowing vis-a-vis debt issuance. Next chapter is chapter 1.3, the bond market ecosystem. The debt market deals in both government as well as non-government debt instruments. The market has three important functionalities. A is issuers like government and corporate firms. B is intermediaries like merchant, bankers, and brokers selling debt. And C investors like commercial banks. Collectively, investment schemes like mutual funds, pension funds, insurance companies, retail investors, etc. Typically, a firm wishing to float or issue debt instruments for raising funds for its business requirements contacts an intermediary like an investment banker or a merchant banker who helps the firm in selling the debt papers to qualified institutional buyers or high net worth individuals before issuing a debt instrument. The issuer approaches a credit rating agency that vets the relative riskiness of the payments promised by the issuer. A debt instrument with a higher rating attracts lower interest rates as it indicates relatively lower risk. All investors who fail to get the instruments in the primary market can purchase those securities from the secondary market. Thus, the three critical participants in the debt market are Issuers are governments, commercial banks, public sector companies, private corporate firms, etc. Intermediaries are investment banks and merchant banks who help issuers to sell bonds to the investors. Investors are the private corporate treasuries, collective investment vehicles like mutual funds, insurance companies, commercial banks, pension funds, high net worth individuals, etc. Investors can further be classified as domestic and international investors. In India, public issuance of a debt instrument has to go through elaborate vetting process as laid down by the Securities and Exchange Board of India. Listing of a debt instrument in a recognized stock exchange and dematerialization of the instrument are important functions to be carried out by the issuing company or by the issue manager appointed by the issuing company. Rating agencies play a key role in summarizing information about the company issuing debt, and this rating information is a key element for the investors, helping them in both the primary and secondary market transactions. The regulators ensure orderly development of the market with fair and transparent practices to protect investors. The Reserve Bank of India, that is RBI, and the Securities Bank and Exchange Board of India (SEBI) are the main regulators of the Indian debt market. We will cover the next part in next video. That's it for now. Thank you.